Good morning. I'm Deepa from MBA department. Last week session we discussed about financial management. What are the introduction, scope, and objectives? Now we are going to see about the next session. Under the next session, we see about the wealth maximization. So, wealth maximization equal to maximization of shareholders' wealth. A shareholders has shares in the company or business, and its wealth will improve if the share price in the market increase, which increase in turn of functions of net worth. So the value of company shares will be increasing, the shareholders wealth also increasing. So wealth equal to NPV, that is a net present value of financial decision equal to present value of future cash flow minus cost. So they want to maximize the profit and reduction of cost. Under this wealth maximization model, West profit maximization model, it is based on the cash flow and not a profit. Profit and the manipulating changes in the assumption depreciation. So profit maximization present in the short term and viewed compared to the wealth maximization. Timing of return ignored in the profit maximization. So consider the risk and the uncertainty fact while considering the discounting rate. So EVE, earning value of analyzing equal to NOPAT minus capital employed into WACCO. So source of wealth creation comes under the industry attractiveness and the competitive advantage. Under the industry, it will be the competitors, substitutes, bargaining power of buyers, bargaining power of suppliers, competition among competitors. Under the advantage of the competitive, cost advantage and the differentiation advantage. Next, under this, we can see the difference between the profit maximization and wealth maximization. Under the profit, it does not take into the account time of value of money. It takes in the account time value of money. Under the profit you have, it does not consider the uncertainty of the future earning. It takes into account and risk of factor. Next point, it does not consider the effect of dividend policy on market price of shares. It takes into the account and affect the dividend policy of market price of shares. It does not differentiate between the short-term and long-term profit. It considers the different strategies of long-term and short-term profit. And that we can discuss about the difference between the profit maximization and wealth maximization. Next slides, it will be show the principle of finance. It shows a business proposal under the new investment or acquisition of another company or restructuring initiatives and a raise of the value of firm only if the present value of the future streams of net cash benefits expected from the proposal is greater than the initiative cash outlet required in the implement of proposal. So first we see the investor, shareholders and lenders. It will be going for the proposal of the business. So investors provide the initial cash requirement to finance the business proposal. Next one, decision, return, risk and market value and scope of financial management. Under this, first we see the capital budgeting decision, capital structure decision, dividend decision, working capital decision. Under this, it comes under both risk and return. So under the risk and return, it comes under the value of the market value of the firm. Next, we see the scope of financial management or decision. Under you have the four types. First is the investment decision, financing decision, then dividend decision and liquidity decision. Under the investment decision, investment is a short-term and long-term project. Under the short-term, it related to the working capital management, inventory management, receivable management, etc. Under the long term, it comes related to the traditional and modern. Under the traditional payback period, accounting rate of return. Under the modern net present value method, internal rate of return, profitability index, etc. Next, financial decision. So under dividend decision, it related to the how much the earning comes under the distribution of dividend and how much to be kept as a retained earning. So under this, you have so many ratios like liquidity ratio, profitability ratio, then current ratio, then return on investment, earning per share, then earning before interest and tax, and under the tax you have the so many methods. Under this you have the direct and indirect tax, and the direct, what are the gift tax, like that, so many is there. So it all comes under the dividend decision. Thank you.